Annuities at 7.
Are you buying annuities? If so, you're not alone. Chase Wilsey of Wilsey Asset Management is here to share what to watch out for and what's right, what's wrong for you. Chase, good morning.
Good morning.
Okay, talk to me about this. More people are buying annuities, right? Explain what that is, first of all, and then why they're buying it.
Well, first of all, it's not more people, it's the most people that we've ever seen.
Wow.
We're about to see a record for annuity sales this year, on pace for about $300 billion. Last time we saw anything remotely close was 2008 when there was $265 billion worth of annuities sold. So again, we're seeing record levels. Now, an annuity, what it is, there's different types. There's immediate annuities, fixed annuities, variable annuities, indexed annuities. So there's all these different things, but essentially, instead of investing in bonds or stocks or real estate, you're investing in a contract. You're investing in kind of a future of payouts. Basically, it's a contract that you're looking at.
You mentioned 2008 was the last time we had this many. We all know what happened in 2008. Is there a pattern to be read into that or not really?
Absolutely. Annuities are generally sold on fear. It's when you're seeing a lot of stock market volatility, it's like, oh, are you worried about the volatility? Because that's what annuities' main selling point is. It's like it removes that. Are you worried about downturns in the stock market? We can write a contract essentially that eliminates that downturn. It makes people feel good about it. What about guaranteed income? Those are two of the big main talking points that people look at when they're buying annuities.
What about guaranteed income? Do you get it with an annuity or not necessarily?
You can. It's specific to how that contract is written. So it's something to look out for, but there's a lot of different underlying elements that you have to look at when you're buying that annuity, because you hear all the good things, but many times you don't hear the bad things that come with the annuities.
So what do we need to watch out for if we're looking into this?
So as I said, it's a contract. So many times they're very, very lengthy. You got to read the fine print here. There's some big things. There's two that I like to point out is participation rates and rate caps. So the participation rate, let's say the stock market goes up 10% and that's what it's indexed to, but you have a 60% participation rate. Well, that means your annuity only went up 6% that year. The other thing is a rate cap. Let's again use that 10% gain for stocks, but your rate cap is 5%. You only get 5% that year. And the big thing I like to point out to people is stocks over the last 40 years are positive more than 75% of the time. So you're giving up the downside, yes, but you're also giving a lot on the upside. You have to be very cognizant of that. You got to watch out for a lot of the other hidden factors of the annuities as well.
If you're not an expert at stocks and all this kind of financial stuff, and you go to somebody like yourself and say, well, what would you recommend for me? Do you have to read into that person's personality? Are you more conservative? Do I have more conservative options? Do you keep me with the stocks, or do you do annuities? How do you determine what's right for that client, for that person?
You know, I don't sell annuities. I would never buy an annuity personally. I think there's a lot better options out there when it comes to investing and buying good quality investments. The big thing I tell people is learn.
Even if you're conservative with the money and know what you want.
Even if you're conservative with it. I don't like annuities. I think you're giving up too much on the upside. And if you look historically, I think it's far better to own good investments than to buy these contracts. And especially the way they're sold, a lot of times there's like riders in them that add expenses. There's so many fees that come out of the annuities that it really actually limits your investment gains in the long term. I've seen some terrible news over the last couple of days of surrender charges. One client wanted to get out of his annuity, but there's a 12-year surrender charge. So you can't get out of it over that 12-year period without paying maybe 8–10% of a penalty. So you lock your money in, which is another reason I just don't like it. I don't like having limited options. I like flexibility when I invest my money and my clients' money.
And yet they're at a pace that's, so how do you explain that? I mean, I trust your judgment, but then you see that so many people are going for this.
You just, again, have to ask the tough questions. Number one, I always tell people, ask that salesman how much of a commission they're making. Annuities come many times with a 6 to 8% commission. It can be very, very high. What are the expenses? What are the potential downsides? Once you annuitize an annuity contract, once you get locked in, I talked about the surrender charge, but the annuitization of it, you can't go back on that decision. You can't say, oh, I want my money back. No, you already signed the contract to annuitize it. Be very, very careful, as those decisions can impact your lifetime investments. I hate locking my money up. I like flexibility, as I said.
Listen, this is why I call Chase. This guy. Chase Wilsey, we thank you as always for the expertise.
Thanks for having me.
All right. Still ahead here on the podcast.